Every one of Canada's big six banks beat analyst expectations in Q2, and 5 of the 6 raised their dividend. The headline read as a clean sweep, but the market's response inside the sector was not uniform, and that divergence tells a more useful story than the consensus beat. Royal Bank posted $5.51 billion in net income, up 25% year-over-year. TD Bank's adjusted earnings rose 15% to $4.17 billion. CIBC, BMO, Scotiabank, and National Bank all cleared the bar. What made the quarter look this strong was not a surge in loan growth or fee income. The dominant factor was a sharp drop in provisions for credit losses, the reserves banks set aside against bad loans. RBC's provision for credit losses fell to $912 million from $1.42 billion a year ago. TD cut its PCL to $1 billion from $1.34 billion. BMO dropped from $1.05 billion to $739 million. That collective drawdown of roughly $1.5 billion in reserves across just 3 institutions flowed directly into net income, inflating the earnings beat beyond what operating performance alone would justify. The question that beat compression raises is not whether the banks did well. They did. The question is what licensed the reserve drawdown and whether that license holds. Scotiabank's chief risk officer flagged that macroeconomic uncertainty, specifically the U.S.-Iran conflict and trade policy, will maintain pressure on PCL going forward. That forward guidance is the thing the headline earnings number does not resolve. The PCL drawdown tracks directly to one external event, the tentative 60-day ceasefire extension between the United States and Iran, negotiated on May 28, which opened the prospect of oil shipments resuming through the Strait of Hormuz. Oil edged lower on the news. That move mattered to Canadian banks because the Iran conflict had been the primary driver of elevated inflation and compressed loan growth since early 2026. TD's economic outlook, published alongside its Q2 results, made this explicit. The bank's economists wrote that the conflict had already lifted inflation and is expected to continue to put downward pressure on global growth. The Strait of Hormuz disruption was described as the dominant near-term theme weighing on growth across much of Asia and Europe, and by extension on Canadian export conditions. The Bank of Canada had held its overnight rate at 2.25%, unchanged since mid-2024's easing cycle, partly because oil-driven inflation offset the space that Canada's slack labor market would otherwise have opened for further cuts. A 60-day truce changes that calculus, but not permanently. The ceasefire requires Trump's formal approval and remains a memorandum of understanding, not a signed agreement. TD Economics now forecasts no rate change from the Bank of Canada through the remainder of 2026, but that projection was built on the assumption that the ceasefire holds and oil prices moderate. If the agreement collapses and Hormuz restrictions resume, the inflation input rises again, PCL would need to rebuild, and the Q2 earnings beat becomes the high watermark rather than the floor. Foreign institutional capital, which had been underweight Canadian financials through most of the Iran conflict on the assumption that PCL would stay elevated, rotated back into the Big Six through May. That flow is visible in the 5 dividend increases and the broad outperformance of the TSX Financials Index relative to other sectors over the past month. The rotation assumed the ceasefire would hold. What it has not priced is what happens to that positioning if the truce lapses inside the 60-day window. CIBC stock fell 5.4% on May 28th, despite posting earnings that topped analyst expectations. That drop, while the sector broadly held, isolates the specific stress point the market is watching inside the otherwise uniform beat narrative. CIBC simultaneously announced a US $1.6 billion sale of its Caribbean banking unit. The divestiture releases capital and reduces geographic complexity. On paper, strategically positive. But the market's reaction priced 2 things the divestiture announcement surfaced rather than resolved. First, CIBC's net interest margin rose 17 basis points year-over-year, but fell 1 basis point from the prior quarter. In an environment where deposit competition is accelerating, Canada's banking regulator is actively streamlining entry paths for new players and fintechs, a margin plateau signals that pricing power is softening at the same moment operating cost pressure persists. Second, CIBC's stock had climbed 60% over the prior year, outperforming all major peers. That run had priced in continued margin expansion. The 1 basis point sequential decline was not large in absolute terms, but it was enough to invalidate the expansion trajectory that the premium valuation required. Institutional holders who bought into CIBC's relative strength story over the past 12 months were repricing their forward margin assumptions in the same session they received a strong earnings report. CIBC Chief Financial Officer Robert Sedran framed the competitive environment as manageable. The bank is deepening relationships, not competing on price for market share. That framing is not wrong, but it describes a defensive posture. The capital released from the Caribbean sale gives CIBC flexibility. It could accelerate buybacks, fund domestic expansion, or reduce leverage ahead of a worsening credit cycle. What the market sold was not the divestiture itself, but the absence of a clear deployment plan for net capital at a moment when the domestic margin story is decelerating. The monitoring variable is CIBC's net interest margin trajectory in Q3. If the 1 basis point sequential decline is a transient competitive spike and margin resumes expansion, the Q2 drop resolves as a re-entry point. If margin stays flat or compresses further while the rest of the Big Six hold their spread, the relative value gap that drove CIBC's 60% run closes, and the sector-wide earnings strength no longer applies equally across all 6 names. Every day after the close, we publish a market wrap and key issue analysis. Subscribe to the channel.